Hello, this is Cynthia Fick, and this is your January 24th stock market update. Well, another exciting week in the market. I bet you're all going to be in shock if ever I don't say that. So, as I've been saying, it looks like the stock market has started a rally this year that could be sustainable because some of the market internals have changed a bit. And so we're just waiting and watching just to let it show us what the market wants to do. So let me go straight to the charts and show you why I think there's again, that glimmer of hope that I talked about last time. Okay, let's look at the chart of the S&P 500. And this goes back to, 2022 when we started the downturn. As you can see, we started our downturn and there were a few times last year where the market went up and tried to break through this downward trend line and just couldn't do it. Every time it reached the line, it would get turned down. And here we did it again in late November, hit the 4,072 point and then got turned down again. See, we've got a more shallow retracement right here. We're back up again this year, hitting that line. And the interesting thing that happened is that yesterday and maybe even today, we went up and touched that line, kind of pierced it on the upside. So that could be an idea of things to come. One of the reasons is that another one of the Fed board members came out and basically, Esther George, and basically said that she thinks a soft landing is still possible for the United States. So this is the second board member that's come out saying something like that. And why are they saying this? Let me show you. Basically, when we look to say we are in a recession, here's the kind of things. There's 6 indicators that they're watching to decide if we are in a recession. And the 2 most important one, it says here, in recent decades, the 2 measures we have put the most weight on are real personal income, less transfers, and non-farm payroll employment. So those are the things I'm going to focus on today. And I show you the difference between our last big recession in 2008, 2009, and then what's happening right now. Okay, this is the number 1 thing they look at to determine if we're in a recession. And you can see it's real personal income excluding current transfer receipts. So this is August of 2008, similar point in an economic cycle that we're in right now. And as you can see, the indicator went crashing down. Okay, so basically we have a downtrend line right there. Well, you look at the same point in the economic cycle that we're at today, and it's quite the different case. We are actually, up to where we were, just a couple of years ago. So this trend line is a sideward moving one, whereas this one is a definite downturn, totally different scenario. And this is one of the major things they look at to see if we're in or going into recession. The next one is the second most important one. They said the total non-farm payrolls. How are they looking? Well, this is in 2007, 2008. What did it look like then? We had a definite downtrend going on, same time in the cycle. And quite the opposite, we have an uptrend going on. So, and this is just as of January 2023. So this may be why the Federal Reserve is thinking we might have a soft landing. That means avoid recession. And that may be why the stock market is trying to rally. It's very interesting because if we don't have a recession, then what I had been concerned about last year, that we'd go into, a bigger pullback, most likely won't happen, because if we go into recession, the stock market is upset and concerned that will really hurt corporate profits, which again will reprice the stock market completely. Maybe that's not going to happen. The 2 most important things to signal a recession are not happening right now. Okay. Here's another thing. A lot of you had asked me about the debt ceiling, and there's all the talk. Are we going to have a big political battle over the debt ceiling? And we very, well might. But always remember this. What politician wants to have it on their record that they said, yes, let's default on U.S. government debt? I don't think any of them would think they could get reelected if they voted to default on U.S. government debt. So that's just kind of the underpinnings of all this kind of political battle we see going on. But here's the last time. It was 2011 when a very similar thing. Obama was in office at that time, and we had the same kind of battle going over the debt ceiling. And look what happened to, this is the index fund that tracks the 20-year treasury bond. Okay. This same index was down 31% last year as they raised interest rates. The bond prices came down and it was down 31%. Well, look what happened in 2011 during this debt ceiling crisis. That same TLT it's the 20-year treasury index went up a total of, during that year, 42%. So, you might see some TLT, which is the treasury, 20-year treasury bond index, added to your portfolios if we need a little bit more bond exposure. So these are the things we're watching. It's important to keep an open mind because things are changing so quickly. I know it feels confusing. If you can just kind of turn down the volume on whatever programs you watch. And I try to take everything I study and learn and bring it all together and present it to you in a non-biased manner. And that's what I'm doing right now. And so we have to be open-minded that this stock market could rally, because there's a lot of things at the surface saying we may not go into recession. So again, I will see you next Tuesday. Have a great week, and I'll talk to you then. Bye.